Okay, yes. Good evening, everyone. Thank you for having me. I thank my professors and I thank you for being available to supervise this defense. So today I'll be defending the thesis titled "Scaling Financial Inclusion um, to Drive Banks' Annual Deposits Increase in Sub-Saharan Africa." And there is a reason for choosing this topic, but essentially it's all around increasing the percentage of banked adults population using Nigeria's financial access data modeling. My name is Akinyemi Sadeeq Akintola, and I will be making some basic information about this right now. Um, just in a nutshell, there's some key learnings about this thesis that I want to mention, just to highlight some key numbers or some key points before delving into the main topic. So this is like a 10,000 feet discussion. About 1.7 billion adults globally lack access to financial services. That's about, with my calculation, one eighth of the total population of the world now. But the problem about that is Nigeria, the country where I come from, is one of those five countries that contributes to close to half of that number. So that means Nigeria is really hit with financial exclusion in a big way. The impact of this is that it hinders national growth, and I will explain that in a couple of seconds. The current strategy is that banks attempt to, throw everything that they have against the wall, just so that they meet anybody that seems to be interested in their services. And with this kind of method, they waste a lot of energy in trying to target everybody, and that is not the right way because there are some natural inhibitors that prevent people from being potentially being financially included. So we believe that the strategy of the banks trying to mass market everybody is not a good way. So this research is trying to identify, using data, using AI and machine learning to try and identify potential bank customers who, if the banks target this specific people, then they will be making a good use of their time. So we want to do this through predictive modeling. The objective is to create a machine learning model to help differentiate between, who is a banked customer or who is not a bank customer. With this information, then we will be able to say, yes, if we are able to target specific number of people, then the efforts and energy and finances that the banks or financial institutions use to, target these people will be a lot more fruitful. How do we want to do this? We try to use the only data on financial inclusion that is available in Nigeria, which is the A2F, access to financial services. We were able to gather about data from surveys of about 100,000 respondents. The initial analysis on that, we're able to get identification of, who are banked individuals and who are non-banked individuals. So we're trying to, get a persona of who really is going to be a banked customer and who is likely not to be. So we're trying to build those characteristics. And from our key learning, one of the things that we saw was that, there are a lot of factors that affect someone after we built this persona. There's a number of factors that affect someone being, having financial inclusion, which is, level of education, the age, the gender, sadly the gender, because yes, and I will get to that in a bit. The state of residence, where they live, is it rural, is it urban? Then the kind of, the kind of jobs that they currently have, if they're working at all. The implication for this is that, there has to be, and it's not just, even though this research is focused on the banks, there has to be consistent efforts, not only from the banks themselves, but also from external parties, especially the government, if we really want to increase this number. So there's just a bit that our machine learning can do, but there has to be some efforts from every other person. So moving forward, I want to kind of start on a general understanding of what is financial inclusion. The World Bank defines this as the access to useful and affordable financial products and services, transactions, payments, savings, credits, insurance that meet individuals and businesses' need in a responsible and sustainable way. Now, in my experience, I know that, having access to the bank, and from the research that I did on this thesis, having access to the bank is the lowest level of being financially included. Once you have a bank account, you can easily be counted as someone who is financially included. But there are some other indicators that show financial inclusion, which is the usage, which is how much people are actually using so I have a bank account. Yes. What do I do? Do I just receive payments, or I send payments? I do trading. I do extra things. Now, the level of usage is also a means of, knowing how people are using, how deep people are included. Then also the quality, how happy are those people that are using it? How satisfied are they with what the services that they're using? Now, looking at Nigeria, which is our case study, there are some things that we should discuss around Nigeria. And, it's been coming from a very, very worse number into maybe recently, where the number is getting a little bit better based on some research that we did. Now, Nigeria's financial inclusion has been growing steadily, but not in the most encouraging manner. There's still a lot of work to do. But the thing that should be noted is the number of bank population has increased from, Nigeria has a population of 202 million. So we expect there has been an explosion of population growth over the past few years. Now, there is also an increase in the banked population, but it still doesn't reflect what we want to see based on the target of the government. These are some statistics that we got from the literature review of what has been going on in the financial inclusion space in Nigeria. And that is to say that, again, the numbers are increasing. Now, it's good to mention here that the data that we considered for this thesis is from 2008 to 2018, because it's a 2-year, it's a biennial data that the institution, EFINA, gets every 2 years. So it takes some time for the data to come out. So at the time of request, we're able to get 2008, 2018. However, there are some literatures, there are some theses or papers out there that have actually done some research as to what the population of Nigeria is, what the financial inclusion is. So those ones are kind of available. And it has grown up to 50.5% in 2023. And there has been some financial technology companies that have also sprang up to fill in the holes of where these banks are not really playing very well. So there's been some uptick in how Nigeria has grown. But it is also important to note that, the role of financial inclusion in any country is really, really important because it's a driver for economic development. The more there's a bulk of funds, especially from the bank's perspective, that is being able to be distributed to every other small businesses, individuals, then the more those small businesses will grow and will be requiring services from the banks as well. So there's a multiplying effect for financial inclusion in any economy. And one thing we see is that there are some factors that affect them, which is education, unemployment, proximity to financial services. And these are things that, everybody needs to take care of, not just the banks, but also government. I will not want to dwell so much on this just to make sure that I'm trying to keep to time, but I'm sure if there are questions, there will be some touch points later on this. But the point I want to make here is Nigeria has a lot to learn from different geographies, especially not even Europe's or America's, that have kind of perfected a way of including a lot of people, even economies that are similar to Nigeria's, which is India. There are some things that they've implemented, like the PMJDY, which kind of helps to galvanize financial inclusion among the citizenry, and it was a great success that Nigeria can learn from. But more of that in the bit. There are ways that machine learning can actually help in building financial inclusion into the fabric of the economy. Now, I went to India just to cite an example, but India is so far-fetched. Even in our backyard in Africa, there is Kenya that implemented the M-Pesa around 2006. And before 2016, they were just 26% in 2007 of financial inclusion. By 2017, Kenya has risen to close to 75 to 80% of financial inclusion. And that is by the use of M-Pesa, which is like a mobile system of, sending and receiving money and getting a lot of people in the rural environments into the fold of using, a financial tool that is quite available to everybody, because as at that time, people have started having phones. So there's a lot Nigeria can do, and there's a lot AI and ML can do to assist us in getting to that position. So before now, part of the literature that we did pointed to the fact that there's actually some ways that banks, and not just only banks, I mean, most businesses try to use financial inclusion, try to use AI and machine learning to get the desired products and services to their potential customers. And these methods can also be applied in financial inclusion. There's AI and ML, algorithm to, analyze customer data. The more data that can be analyzed, then you can target a specific marketing campaigns to specific set of users with specific persona. With that, you will be able to not only drive inclusion, but also usage and utility of your products and services. There's another one, which is real-time personalization, and this one is very personal to me. There's a specific amount I send to my spouse every month. Now, there was a month that I spent something a little bit lesser, and what I realized was that the bank kind of told that in a personalized way instantly that, oh, this also person used to send you this amount, but it was like 100 or 200 short. Do you want to tell them? These are ways that financial inclusion, machine learning can help with financial inclusion on our financial services. With that in mind, I am very much sold out on that product of services. Now, it would allow me to deepen my usage of those financial products, because I believe that they're personalizing and customizing those products and services for my basic needs. So there's a lot financial AI and ML can do with helping to solve specific problems with financial inclusion. Now, speaking of the data that we used, I've mentioned some things around the data, so I would not want to dwell so much on this, but we got data from 2008, 2018. Every year, the data is about 2,500 columns wide, and there is never a year that we had nothing less than 18,000 records. So these are things that we have to distill together to get the whole data. So we do some pre-processing, and we imported those data into Google BigQuery, and we're able to, using SQL and data engineering to get the data, clean them, and have them into a format that is usable. At the end of the day, this is what we ended up with. We've got like 15 to 16 columns. The bank status was the target variable, so we're able to use that to make our predictor to say this is customers that are banked, and these are customers that are not banked. These are some exploratory data analysis. The first one up there, the top corner, shows like the top 9 obstacles of having a bank account for Nigerians. And we realized that sadly, people don't have regular incomes. About 35% of people couldn't, couldn't have regular income to be able to save in banks. And on the top bottom corner here, we see the correlation matrix. One thing that interests me the most is the correlation between access to mobile phone and bank status. That is how much, and also education level, obviously, how these this data points can actually affect the people that are either banked or not. So that told us automatically that there's a need to get people to be informed in modern ways. Now, this research used different machine learning models, logistic regression, naive Bayes, XGBoost, and neural network to build different models. And with these models, we're trying to predict which model will serve the purpose of predicting which individual would be. Yes, sorry.
Yeah, just asking you to go a little bit faster. You have 1 minute left.
Yes. Okay. So the best model that we saw was XGBoost. It gave us 83% accuracy. There could have been other models, but this was the one that was good across all the values that the precision, recall, F1 score, accuracy, ROC, area under the ROC curve. So we're pretty confident that this is the best model across. Now, we didn't stop there. We tried to do, we don't try to build a black box. We try to do some bit of explainability just so that we're able to explain the results that we get. So for the negative results, we're able to show that these are the contributors that make this person not to be included. So, and we can see they don't have a lot of, if you look at the intercept part, they don't have a lot of factors contributing to letting them be included. But if you look at the ones that have a positive prediction, there is just a very little. I mean, people within the age of 21, people whose monthly income is ranked 1, I think 5 is the highest. You can see the pattern there that people that are having good jobs, live in rural, urban areas, are potentially, predicted to be included. So these are the conclusions, but hopefully we'll get there during the question and answers.